Imagine, if you will, a fortress. And I don't mean, a metaphorical one or some digital firewall on a server somewhere.
Right.
I want you to close your eyes and picture a literal medieval castle. We are talking thick, gray stone walls that have stood for centuries.
Okay, I'm with you.
We are talking about a drawbridge that is permanently cranked up, with these heavy iron chains just rusting in the air.
Mm.
And surrounding this entire structure is a moat so wide, so deep, and so treacherous that you would need a telescope just to see the archers patrolling the other side.
That is quite the image.
Now, if you were a king or a queen in the Middle Ages, that is exactly where you would want to keep your gold, right?
Yeah.
Safe, secure.
Oh, absolutely. It certainly beats burying it in the backyard or stuffing it under the mattress where the moths can get at it.
Exactly. Now, fast forward to the modern financial world of late 2025. That fortress, it actually exists. It doesn't look like a castle with turrets and flags, though. It looks like the Canadian banking system.
Yep.
And sitting right in the middle of that keep, arguably the biggest and strongest tower of them all, is the Royal Bank of Canada, or RBC.
It is a really fitting image. I mean, when you look at the global financial landscape, especially as we close out 2025 and look ahead to 2026, Canadian banks really do stand apart.
They do.
They're insulated, they're heavily regulated, and they're profitable in a way that is, it's unique to that specific market. They're basically giants roaming in a protected garden.
And that is exactly what we are unpacking today. We're doing a deep dive into the Royal Bank of Canada, ticker symbol RY, for those of you tracking this on your terminals or your phone apps.
Right.
We're basing this entire conversation on a really comprehensive equity research report from Morningstar, specifically the update dated December 18th, 2025. And I had to say, looking at these notes and the data provided, there is this fascinating tension right at the heart of the story.
There is. It's the classic battle. It's price versus value. And as any seasoned investor knows, those are, they're rarely the same thing.
Right. So let's set the scene for you listening. It's late 2025. If you look at the stock market, RBC is trading at roughly 228 Canadian dollars.
It had 228, yeah.
Investors are cheering, the chart looks like a staircase going up to the right, and everyone seems happy. It feels like a party. But then we open this report from the Morningstar analyst, Ma-Yun Chen, and he is flashing a big red light.
A very big red light.
He has slapped a 1-star rating on the stock.
Which, in Morningstar's language, that is the strongest warning they have when it comes to valuation.
Right. What does it actually mean?
It basically translates to significantly overvalued. It's the analyst shouting from the rooftops, "Hey, pump the brakes."
Correct. And to be precise, while the stock is hovering around CAD 228, Morningstar's fair value estimate, which is what they calculate the business is actually worth.
What the fundamentals say it's worth.
Yes, exactly. Based on the cash it will generate in the future,
Yeah.
that number is sitting way down at CAD 2196.
That is a pretty significant gap. You're looking at a premium of roughly 16% over what the fundamental experts think the company is truly worth.
16%.
That's a hefty markup. It's like walking into a car dealership and, voluntarily paying 16% over the sticker price just because everyone else is doing it.
So that disconnect is the core mystery we need to solve today. Why is the market so euphoric? Why is the analyst so cautious? And if you hold this stock, or if you're thinking about buying it, who should you believe?
Yeah, where's the truth?
To get to the bottom of this, we have a mission. We are going to unpack 3 main things.
We need to look at the structure, we need to look at the recent performance, and of course the risks.
Exactly. First, we're going to look at the fortress itself, what Morningstar calls the wide moat. Why is it so incredibly hard to compete with RBC? Why hasn't some, Silicon Valley startup eaten their lunch yet?
A very good question.
Second, we need to talk about what I'm calling the sugar rush of 2025.
The trading income spike.
The massive trading income spike. We need to understand if that's a permanent new level of fitness or if it's just a temporary caffeine high that's, going to lead to a crash.
Mm-hmm.
And third, we have to look at the storm clouds outside the castle walls, the macro risks like tariffs, trade wars, and the ever-looming specter of the Canadian housing market.
It is a complex picture. You have a fantastic business. Probably one of the best run in the world, but even a great business can be a bad investment if you pay the wrong price.
Okay, let's unpack this. Let's start with that price tag. Section 1, the valuation disconnect.
Let's get into the numbers.
So we established that the stock is trading around CAD 228. The fair value estimate is CAD 196. Now, here is the wrinkle in this.
Mm.
The analysts actually raised that estimate recently.
They did.
It used to be CAD 169.
Yeah.
So they are acknowledging that things are getting better, right? They aren't just being, grumpy contrarians.
Not at all. And it's really important for investors to understand where that increase came from. The analysts didn't just wake up feeling optimistic or, decide to be generous. They ran the math.
Okay.
The bump in the fair value estimate, that roughly CAD 27 increase, comes from very specific drivers.
Break that down for us. I mean,
Yeah.
where does an extra $27 of value come from in a bank that's over 100 years old?
Well, the bulk of it, about CAD 20 of that 27, comes from higher short-term growth and profitability.
Okay, so just better performance right now.
Essentially, yes. The bank made more money recently than the models originally predicted. The cash register just rang louder than expected in 2025. When a company generates cash now, that cash goes onto the balance sheet and it increases the value of the firm immediately.
Okay, so that's real money in the bank. They outperformed. That makes sense.
Exactly. Then another CAD 4 comes from better midterm profitability prospects.
Midterm, so like the next few years out.
Exactly. This implies that the analyst believes the efficiency or the margins will stay healthier for a bit longer than they previously thought. They've looked at the operations and said, okay, you know what? This machine is running smoother than we gave it credit for.
All right, so that's $24 accounted for. What's the last three?
And finally, CAD 3 comes from the time value of money.
Time value of money. Okay, that's a Finance 101 term, but it always trips people up. Can you just refresh us on that?
Sure. Simply put, cash flows moving closer to the present are worth more. A dollar today is worth more than a dollar 5 years from now because, you can invest the dollar today.
Right, opportunity costs.
Precisely. So as we move forward in time, the future earnings we were discounting are now closer, so their present value ticks up a little. It's a mechanical adjustment, really, but it adds to the price target.
Okay, so let's recap this. The business is performing better. They've crunched the numbers, they've given RBC credit for the extra cash, for the better outlook, and they've raised the target to CAD 196. But even after giving them all that credit, even after acknowledging the great year, they still say, stop, it's too expensive at 228. Why? What is the market seeing that the analyst isn't, or, vice versa?
The term the analyst uses is overextrapolation.
Over-extrapolation.
Yeah.
Okay, that sounds like a very fancy way of saying getting carried away.
That's exactly what it is. I mean, in behavioral finance, overextrapolation is a very, very common bias. It's when investors look at a recent trend, say a really fantastic year of earnings, and they assume that this is the new normal.
Right.
They assume that that line on the chart will just keep going up forever at the same steep angle.
Ah, the old trees grow to the sky fallacy.
Mhm.
RBC made $1 billion today, so they'll make $2 billion tomorrow and $4 billion the day after that.
Precisely. It ignores cycles. It ignores mean reversion. And in RBC's case, the catalyst for all this excitement is specifically what happened in 2025 regarding their capital markets division.
The trading desk.
The trading desk. They had an absolute banner year. But the analyst is arguing that this was a cyclical high, not a permanent structural shift.
And that's the key difference.
It's everything. If you price a cyclical peak as if it's permanent growth, you end up overpaying significantly.
So the market is looking at 2025 and saying, wow, look at all this cash. This is how it's going to be forever.
Mm-hmm.
And Morningstar is looking at 2025 and saying, enjoy it while it lasts, because gravity is coming back.
That's the crux of the entire argument. And it's a dangerous trap for investors. You see the stock going up, you see the headlines about record profits, and you buy in. But if those profits were a one-time bonus rather than a permanent salary raise, you're buying at the top.
But to really understand if RBC can sustain this, or if they're just, riding a wave, we need to understand the foundation of the bank. We need to understand the fortress.
Yes.
Because even if trading slows down, the walls of the castle are still there.
Exactly. And that brings us to the concept of the moat.
Section 2. The fortress anatomy of a wide moat. Now, regular listeners know we love the concept of an economic moat. But for anyone joining us for the first time, or for those who hear the term thrown around loosely on cable news, let's get a definition on the table.
Sure. The term was popularized by, of course, Warren Buffett, the Oracle of Omaha. An economic moat is a structural advantage that protects a company's profits from competitors.
The castle analogy again?
It's the perfect analogy. If you have a castle filled with gold, which is your high profits competitors are going to try to storm the castle and take it. They will lower prices, they'll offer better products, they will try to steal your customers. The moat is what stops them.
It's the reason why you can't just start a cola company tomorrow and, beat Coca-Cola. They have a brand moat.
Exactly. And Morningstar gives RBC a wide moat rating.
And wide is the best, right? That's the
Yeah,
top tier.
yes. That is the highest rating possible in their methodology. It implies a very high degree of confidence that RBC will earn excess returns. That means returns above their cost of capital for at least the next 20 years.
20 years. I mean, that is a lifetime in the financial world. Think
Yeah.
about where we were 20 years ago. No iPhones, the financial crisis hadn't even happened yet. To predict a 20-year advantage that's bold.
It's very bold.
So what is this moat made of? Is it technology? Is it their brand?
It's a combination, but structurally, it rests on two massive pillars. The first is cost advantage, and the second is switching costs.
Let's break those down. Cost advantage sounds simple. They do things cheaper. But how does the bank do things cheaper? I mean, money costs the same for everyone, doesn't it? The central bank sets the rate.
Well, not exactly. In banking, your raw material is money. You need to get money in so you can lend it out. RBC has a massive base of low-cost deposits.
Right.
Think about your checking account. You probably earn almost zero interest on it, right? Maybe 0.01% if you're lucky.
Unfortunately, yes. It basically sits there doing nothing for me, just waiting to pay the electric bill at the end of the month.
Well, to the bank, that is essentially free raw material. They take that money you gave them for free and they lend it out at 5%, 6%, or 7% on a mortgage or a business loan. That spread is their profit.
And they have more of that free money than anyone else.
An enormous pool of it. Because RBC is so huge, they have the #1 or #2 market share in almost every single category in Canada. They have this huge pool of cheap funding. Smaller banks, they have to pay higher interest rates to attract deposits. They have to offer you 4% on a savings account just to get your attention.
So their raw materials cost more?
Their raw materials cost more. RBC starts the race with a huge lead because their fuel costs are lower.
Okay, that makes sense.
But it's also about operating efficiency. RBC is a machine. They have incredible scale. And this is where the unique Canadian environment comes in. We have to talk about the oligopoly.
The Big Six. You can't talk about Canada without talking about the Big Six banks.
The Big Six. This is absolutely vital for understanding the Canadian market. In the U.S., you have thousands of banks.
Yeah, a bank on every corner.
It's a fragmented, fierce market with regional players, national players, digital players, all fighting for your business. In Canada, 6 banks control 90% of the market. It's a tightly regulated oligopoly.
It sounds almost like a cartel, but, a legal one.
Well, let's call it government-sanctioned stability. The Canadian government essentially decided a long time ago that they prefer stability over hyper-competition. They didn't want banks failing every few years like they sometimes do in the U.S.
Right, like in 2008.
Exactly. They wanted a rock-solid system, and this creates what's called a regulatory shield.
So how does that shield work in practice? Is it just that it's hard to get a banking license?
That's part of it. The barriers to entry are incredibly high. You can't just start a bank in Canada easily. The compliance costs are astronomical. You need massive capital reserves. But second, and this is huge, there are strict rules preventing foreign takeovers.
Oh, really?
Yes. A foreign entity cannot own more than 25% of a Canadian bank's shares.
Wait. So JP Morgan or Bank America, these titans of the industry with trillions of dollars on their balance sheets, they can't just waltz in and buy RBC.
Correct. They are effectively blocked by law. This protects the incumbents from having to fight off global giants on their home turf.
Wow.
It allows RBC to maintain that massive scale without fear of a hostile takeover. And that scale allows them to spread their fixed costs, things like technology, compliance, cybersecurity, their physical branches, over a massive customer base.
I read in the report that the 4 largest Canadian banks are all bigger than the largest U.S. regional bank, which is that's a wild stat.
It is. It really puts it in perspective. They are global giants, but they grew up in this protected garden. This regulatory environment effectively guarantees their market share for them.
Okay, so pillar 1 is cost advantage, and it's driven by scale and this massive regulatory shield. What about pillar 2, switching costs? This feels intuitive, but explain it in the context of banking.
This is what I call the hassle factor. How much do you love the idea of changing your bank accounts?
Oh, I would rather have a root canal. I mean, seriously.
Yeah.
You have to change your direct deposit, all your bill pays, your Netflix subscription, your gym membership.
Yeah.
It's an absolute nightmare. I probably lose half my subscriptions in the process.
Exactly. And the banks know this. But in Canada, it's even stickier because the competition is so limited.
Ah, okay.
Since the Big Six all offer very similar pricing and products, there's less incentive for you to move. If you move from RBC to TD, you're likely getting a very similar deal. It's not like in other industries where switching might save you 50% on your bill.
Right, if all the gas stations in town charge the exact same price, I'm just going to go to the one that's closest to my house. I'm not driving across town to save nothing.
Precisely. Plus, RBC is excellent at cross-selling. You have your mortgage, your credit card, your investments, and your business account, all with them. Untangling that web is incredibly difficult.
You're kind of locked in.
You are. If you leave, you lose your bundled discounts. You lose your consolidated view of your finances. It's a huge pain.
So the walls are high, and the door is almost locked from the inside.
In a sense, yes. That's the moat. It ensures that the profits keep flowing year after year, largely uninterrupted. It gives them pricing power.
So we had this incredible machine, a protected, efficient, sticky banking machine. But even a fortress can have a party that gets a little out of hand. And that brings us to 2025, Section 3, the sugar rush.
This is where we explain that overvalued rating. This is the anomaly in the data.
So 2025 was a good year for RBC, but specifically their trading income. It went through the roof.
It was a monster year, an absolute monster year. Trading income grew by 34%. To give you the raw numbers on that, trading income was CAD $3.1 billion in 2025.
$3.1 billion.
Is
Is that normal? Can you contextualize that for us?
It's not even close to normal. If you look back at the 2020 to 2022 period, trading income usually ranged between, say, CAD $0.9 billion and CAD $1.2 billion.
So it tripled.
It basically tripled the historical norm.
Wow, that is a massive outlier. That's not just a good year. That's a go-buy-a-lottery ticket year.
It is, absolutely.
Yeah. Okay, so let me try an analogy here. Imagine you're walking down the street and you find a $20 bill on the sidewalk. And then the next day, it happens again. You find another one. And this happens for a whole week. You'd feel pretty rich.
You would. You might start thinking you're the luckiest person alive. You might even start budgeting for that extra $140 a week.
But the mistake would be to go out and sign a lease on a Ferrari, assuming you're going to find a $20 bill every single day for the next 5 years.
That is the perfect analogy, and that is exactly what Morningstar thinks the market is doing with RBC's stock price. They are pricing in the Ferrari lifestyle based on a lucky streak of finding $20 bills.
So why was it such a good year? What drove that trading boom in 2025?
It was all about volatility and volume. Trading desks make money when markets are moving and when people are buying and selling large volumes of securities.
So they feed on chaos.
They thrive on it. 2025 saw a lot of activity. We had interest rate shifts from central banks, we had geopolitical tension, we had massive flows of capital between sectors. But here is the catch. Trading is inherently volatile.
Right. It depends on market spreads, volatility indices, and deal flow. It is not like a mortgage payment that comes in like clockwork every single month for 30 years. It can dry up tomorrow. If the markets go quiet, that trading income just disappears.
So what happens when the party ends? What is Morningstar predicting for 2026?
Morningstar is forecasting a normalization, or a reversion to the mean. They expect trading income to decline by 20% in 2026.
Ouch. A 20% drop. That's a significant cool down.
It is. And here is the math of the risk for an investor. If you bought the stock at CAD 228, thinking that 34% growth was the new baseline, and then the numbers come in and they're down 20%, the stock price is likely to correct.
Was the earnings disappoint?
The earnings per share will drop, the multiples will contract, and you lose money. That is the definition of a valuation risk.
It's the hangover after the sugar rush. You wake up, the sugar crash hits, and you realize you overpaid for everything last night.
But, trading is the whole business. RBC isn't just a hedge fund disguised as a bank. They have this massive wealth management division, which the report calls a crown jewel.
Yes, and this is arguably the most attractive part of the business for a long-term investor. If trading is the volatile turbo booster, wealth management is the steady, powerful diesel engine that just keeps chugging along.
Let's dive into that. Section 4, wealth management and the sticky client.
Okay, so wealth management accounts for about 30% to 35% of RBC's total revenue. It's huge. And it's a beautiful business model because it's capital light.
Capital light. Translate that for the non-CFA listeners out there.
Okay, so when a bank lends you money for a mortgage, they have to set aside their own actual cash reserves in case you don't pay it back.
Yeah.
It ties up their money.
Right, it's a risk for them.
It's a risk, and it constrains how much they can lend. In wealth management, they are managing your money. They take a fee for advice and administration, but they don't have to hold massive reserves against it in the same way. It returns a lot of profit for very little capital investment on their part. It's essentially a fee-generating machine.
And the report highlights some incredible statistics about retention rates. This, this really blew my mind.
It is a striking difference between the U.S. and Canada. In the U.S. fund industry, the average retention rate for long-term funds is about 75%.
So 1 in $4 walks out the door every year.
Every single year. About 25% of the money leaves to find a better manager, a lower fee, or just because the client saw a commercial for a different firm and got curious.
Which makes sense. In the U.S., you have Fidelity, you have Vanguard, Schwab, hundreds of independents constantly fighting for your cash. It's a street fight. You can switch with a few clicks on your phone.
Correct. But in Canada, the retention rate is roughly 85%.
That is a massive difference in stability. 10% more of the money stays put every single year. That has to compound massively over time.
It does.
Why are Canadians so loyal? Are they just nicer? Or lazier? What is it?
It's not about politeness. It's all about the distribution structure. In Canada, the banks own the distribution.
What do you mean by that?
If you walk into your local RBC branch to open a checking account, the person across the desk is going to try to sell you an RBC mutual fund.
It's a closed loop.
Precisely. In the U.S., you might go to an independent financial advisor who picks the best funds from 50 different companies. In Canada, the advisor at the bank works for the bank.
Yeah.
And they sell the bank's products. This creates an incredibly powerful network effect. RBC is the largest distribution network in the country. They are everywhere.
So they control the shelf space. It's like if Coca-Cola owned all the supermarkets, you'd probably drink a lot more Coke because Pepsi literally isn't on the shelf.
That's a perfect analogy. And because of this dominance, they have accumulated CAD 1.6 trillion in assets under management, or AUM, by the end of fiscal 2025.
1.6 trillion. That is a staggering number. I mean, that is larger than the entire GDP of many countries.
It is. And they aren't just chasing everyone. They focus heavily on high net worth, or HNW, and ultra high net worth UHNW clients.
Which I assume is more profitable for them.
Much more. Advisors are more productive. One advisor can manage more money if their clients are larger. The fees are higher for specialized services like estate planning or a complex tax strategy.
And the clients are stickier, I'd imagine.
The stickiest. Once you have a complex estate plan, a trust, and a tax structure set up with RBC, you are very, very unlikely to move it all to a competitor just to save 10 basis points on a fee. The pain of switching is just too high, becomes too big to move.
So wealth management is the steady engine. Trading is the volatile turbo booster. But RBC isn't just sitting still. They've been making some big strategic moves. Which brings us to Section 5, mergers and acquisitions.
They have been active. The biggest headline recently, of course, was the acquisition of HSBC Canada.
Right. That deal completed in March 2024. This was a massive deal, Cad. $13.5 billion.
It was the largest domestic banking deal in Canadian history. I mean,
Yeah.
It really shook up the landscape. HSBC was one of the few global banks that had a decent foothold in Canada, and RBC just swallowed them whole.
And what does Morningstar think of it? Was it a good buy or did they overpay?
The verdict in the report is neutral.
Neutral. That
Yeah.
sounds a little underwhelming for a $13.5 billion bet. For transformative or brilliant.
Well, they acknowledged the strategic fit. I mean, HSBC Canada had a great client base, lots of international business, wealthy immigrants, commercial clients with deep ties to Asia and Europe. It plugged right into RBC's network.
So it gave them customers they wouldn't have had otherwise.
Exactly. It gave them access to clients they might not have had before. But, and this is a big but, RBC paid a very full price for it.
The winner's curse. You win the auction, but you pay so much that you can't actually make a good return on it.
Potentially. However, to their credit, RBC is excellent at execution. They hit their cost-saving target of CAD $740 million in 2025.
Okay, so what does that mean? What are those cost savings?
They basically stripped out the redundant back-office costs of HSBC, HR, IT, compliance, and integrated it into the existing RBC machine. You don't need 2 HR departments.
Got it.
Now they are targeting CAD $760 million in savings by early 2026.
So they are good at the cutting part. That's usually the easy part, firing the extra HR department and the IT support, because you already have one. What about the growing part, the revenue?
That's the revenue synergy, and that is always much, much harder to achieve. They are aiming for CAD $300 million in extra revenue by 2027.
And where would that come from?
Things like helping those former HSBC clients with cross-border payments or moving their wealth management accounts over to RBC's platform. It's a show-me story right now. Morningstar is basically saying, great, you bought it, now prove you can grow it.
Okay, so HSBC Canada is a wait and see on value. but a yes on strategy. But then there's the other elephant in the room, the United States. RBC has had a, let's just call it a complicated relationship with the U.S. market over the years.
That is a very polite way to put it. Complicated is generous. I think expensive might be more accurate.
I remember reading about their attempts to buy retail banks down in the U.S. Southeast back in the 2000s.
It was a disaster, an unmitigated disaster. They bought generic retail banks, Centura banks, for example, and they tried to compete head-on with the U.S. giants like Bank of America and Wachovia.
And it didn't go well.
They got crushed by the housing crisis. They realized they had absolutely no competitive advantage, and eventually they sold the entire business at a loss. It was a classic case of diversification.
But they're back. They just can't stay away from the U.S. market. It's just too big to ignore. This time with City National Bank, or CNB, which they bought back in 2015. How is that going? Is history repeating itself?
It's been a bit of a headache recently, to be honest. CNB has been a drag on earnings.
Why? I thought this was a different strategy, a niche player.
It is. CNB is known as the bank to the stars, lots of Hollywood clients, wealthy commercial banking in Los Angeles and New York. On paper, it fits RBC's profile much better than the old retail strategy. It's wealth-focused.
So what's the problem?
But they ran into some serious issues with high expenses and compliance costs. The U.S. regulators are tough, and it turns out CNB needed a lot of infrastructure investment just to get up to code. They had been underinvesting in their systems for years, and RBC had to write some big checks to fix it all.
So as a fixer-upper, they bought a mansion in Beverly Hills, but then realized all the plumbing was broken.
In the short term, yes.
Yeah.
But RBC has been aggressive about fixing it. They've been exiting non-core clients, basically firing unprofitable customers, and investing heavily in their systems and infrastructure.
And what's the outlook?
Morningstar believes they are on track to reach normalized profitability by the end of 2025.
So the strategy this time is, don't try to be everything to everyone in the U.S. Be a specialist for the wealthy and the commercial clients.
Exactly. It plays to their strengths in wealth management. It's a much, much smarter play than trying to out-retail Bank of America on every street corner. You can't beat the U.S. giants at their own game, but you can beat them in a specific niche.
Okay, so we've got the moat, the trading boom, and the strategy. But we can't ignore the world outside the castle walls. Section 6, the macro environment. And the big word here is tariffs.
This was the big scare of early 2025.
Yeah, take us back to February 1st, 2025. What exactly happened?
The U.S. administration dropped a bombshell. Out of nowhere, they announced a 25% tariff on all Canadian goods.
A 25% tariff. Wow. Panic in the streets of Toronto.
It definitely rattled the cages. I mean, you have to understand, Canada and the U.S. are incredibly integrated economies. They make cars together, they trade energy, they trade lumber. A 25% tariff is a massive shock to that system.
And Morningstar reacted.
They did. They actually raised their uncertainty rating for all Canadian banks to medium, specifically because of this announcement.
Because if Canadian businesses can't sell to the U.S., they go bust, and then they can't pay back their loans to RBC. It's a chain reaction.
Precisely. The economic threat is a triple whammy: recession, inflation, because all the imported goods get more expensive, and unemployment. That is the trifecta of bad news for a bank. If people lose their jobs, they default on mortgages. If businesses fail, commercial loans go bad.
But we are now in late 2025. Did the sky fall?
Not yet. The situation seems to have stabilized somewhat. The initial panic has subsided, but the uncertainty remains. Trade deals are still being negotiated.
So the threat is still there.
The report notes that while a full-blown crisis hasn't materialized, the risk is not zero. It's a lingering shadow over the stock. It's like a storm cloud that hasn't burst yet, but it's still hanging there on the horizon.
And speaking of lingering shadows, we have to talk about Canadian housing. It feels like people have been predicting the collapse of the Canadian housing market for, what, a decade?
At least a decade. It's the widowmaker trade for short sellers. Hedge funds from New York look at the data and they say, this has to crash, and they bet against it. And year after year, the market defies gravity, and they lose their shirts.
But the fundamentals do look scary, right? I mean, very high prices relative to income, consumers with a ton of debt.
They do. Canadian consumers are very highly leveraged compared to their global peers.
Right.
They are a lot of money. And crucially, unlike in the U.S., where a lot of mortgage risk is offloaded to government entities like Fannie Mae and Freddie Mac,
Right.
Canadian banks hold a lot of that mortgage risk right on their own balance sheets.
So if I default on my mortgage in Toronto, RBC takes the hit directly. There's no backstop.
For a significant portion of their portfolio, yes. If the borrower walks away, the bank owns the house and they eat the loss. However, there is a silver lining that bears mentioning. Despite interest rates rising significantly over the last few years, mortgage defaults haven't spiked severely.
Why not? I mean, if my payment goes up $500 a month, why aren't people defaulting in droves?
A strong labor market, mostly. As long as people have jobs, they pay their mortgage. They might stop eating out, they might not buy a new car, they might cancel their vacations, but they pay for the house. It's the last thing they let go.
So it's a risk to the economy, but not necessarily to the bank's survival.
That's how Morningstar sees it. They view housing as a future risk to growth, meaning people will spend less, slowing the economy, rather than an immediate risk to capital, meaning the banks will go insolvent from defaults.
That is a key distinction. It might slow the boat down because all the passengers are broke, but it's probably not going to sink the boat.
Exactly. And RBC's capital position is very, very strong. They have a huge buffer to absorb bad news. They are required by regulators to hold significant capital reserves for exactly this scenario. They are built for storms.
Which leads us perfectly to the captains of the ship.
Hmm.
Section 7, Management. Who is steering this fortress?
The man at the helm is Dave McKay. He's been the CEO since 2014.
And I love his backstory. He didn't just get parachuted in from Wall Street or something.
No, not at all. He is an RBC lifer. He started as a co-op student back in 1983.
That is classic. From the mailroom, or I guess in his case, the computer room, to the corner office.
And that technical background really matters. McKay was one of the first bank CEOs to really pivot hard toward technology and payments. He saw the fintech threat coming before many others did.
He knew it was coming.
He understood that if RBC didn't disrupt itself, someone else would. He's been absolutely crucial in digitizing the bank and keeping them ahead of the curve.
And Morningstar gives them an exemplary rating for capital allocation. That's high praise. What does that actually mean in practice?
It basically means they are very good at deciding what to do with the money they make. When a company makes a profit, they can do three things. They can buy other companies, they can pay dividends to shareholders, or they can buy back their own stock.
And they do all three well.
Exemplary means they balance these perfectly. They don't light money on fire on bad acquisitions, mostly. They pay a healthy, sustainable dividend.
What's the yield looking like these days?
For 2025, the forecasted dividend is around CAD 6.04 per share. At current prices, that's a yield of roughly 2.6% to 2.7%. But more importantly, the payout ratio is sustainable. It's around 43% to 50%.
So they're giving about half the profits to shareholders and keeping the other half to reinvest in the business.
Which is a very healthy balance. It allows them to grow the business while also rewarding the owners. And they have raised their targets. Management recently bumped their medium-term return on equity, or ROE, target to 17% plus.
Let's define return on equity for the listener, just quickly.
It's essentially the bang for your buck. For every single dollar that shareholders have invested in the company, how much profit does the company generate? 17% is an incredible number for a massive, mature, almost utility-like business. It implies extremely high efficiency.
It implied world-class efficiency.
Morningstar is a bit more conservative, as they tend to be. They're forecasting around 16.2% to 16.9%, but even that is excellent. It speaks to that wide moat efficiency we talked about at the very beginning.
So let's zoom out here. We have a fortress. We have a great captain. We have a ton of gold in the vault.
Yeah.
But the asking price to buy into this fortress is very, very high right now.
That is the summary in a nutshell.
So let's wrap this up with the so what for you, the listener. If I'm holding RBC stock right now, what should I be thinking?
If you are a long-term holder, you own a quality compounder. It's a sleep well at night stock in many ways. It's not going to disappear tomorrow, but you have to be aware that the current prices in a lot of optimism.
Too much optimism.
You are effectively paying for that 2025 sugar rush to continue indefinitely.
And if it doesn't, what you're saying is likely.
If trading income drops 20% next year, as Morningstar predicts, the stock could face some serious headwinds. It might stagnate or pull back as the valuation compresses. You might see the price drift down to meet the value over time.
So the message is don't panic, but maybe don't expect another chart that looks like a staircase to heaven in 2026.
Correct. And keep an eye on those macro risks. If trade war rhetoric heats up again, or if unemployment in Canada starts to tick up, that housing exposure becomes a lot more relevant.
It's a great house, just maybe not the best time to buy it at an open auction when everyone else is in a bidding war.
A very fair assessment. Patience might be the virtue here for new money.
Before we sign off, I want to leave you with one final provocative thought. We talked about that distribution mode, The fact that Canadians are so loyal because the banks own the branches and the advisors.
The closed loop.
Yeah. Is that actually a moat? Or is it a hidden vulnerability? Because in almost every other industry, retail, media, transportation, the middleman eventually gets disrupted by technology.
That's a great point.
If a new technology or a new regulation ever breaks that stranglehold, if it suddenly becomes easy for Canadians to buy better, cheaper funds from their phones without ever going through the bank, does that sticky money suddenly slide away?
That is the multi-billion-dollar question, isn't it? If the dam breaks on distribution, if open banking truly takes hold in Canada, those retention rates will fall, and the valuation of these businesses will have to be completely rethought. It hasn't happened yet, the walls are still standing, but technology has a way of climbing even the highest walls.
Something to mull over. A huge thank you to the Morningstar team for the detailed data, and thank you for diving deep with us.
Always a pleasure.
We'll see you on the next deep dive. Stay curious.